We've all been there, right? You've got that client who just, poof, goes off the grid, stops answering calls, doesn't file their taxes, and you're left wondering what's going to happen next. Well, when that happens, the IRS doesn't just sit around and wait. Nope. It has this powerful, fully automated tool called the Substitute for Return. So in this explainer, we're going to do a real technical deep dive into this whole process because trust me, understanding how this machine works is absolutely key to protecting your clients from some pretty devastating consequences. So let's just cut right to the chase. What really happens when the IRS decides to step in and file a tax return on behalf of your client? Well, I can tell you it is not a pretty picture. The IRS in this situation isn't trying to be fair. It's not even trying to be accurate in the way that you and I think about it. Its one and only goal is to establish a tax debt and get it on the books. And as we're about to see, they are brutally efficient at it. And the thing they create is called a substitute for return, or an SFR. But here's the part you really have to get. An SFR is a collection tool. It is not a tax prep service. It's built from the ground up to calculate the highest possible tax bill based only on the income docs the IRS has, like a W-2 or maybe a 1099. It just completely ignores any deductions, any expenses, any credits that your client is probably entitled to. The result? A tax bill that can be just astronomically higher than it should be. So, how does this whole thing play out? Okay, here's our game plan. We're going to walk through the 6 main stages of the SFR process. We'll start with the trigger, what kicks this whole machine into gear. Then we'll look at the legal authority for the SFR and, critically, how the IRS calculates that inflated liability. We'll also cover the all-important 90-day letter, get into some really dangerous statutory time traps, and then, finally, we'll talk about how to fix this mess. All right, first up, the trigger. What sets this whole automated process in motion? It's actually incredibly simple. A taxpayer just fails to file a return that they were supposed to, and the IRS knows they had income. So the IRS has this massive computer system, right? It's called the Automated Substitute for Return Program, or ASFR for short. And this system is programmed to do one thing and one thing only. It scans for taxpayer ID numbers that have income documents attached to them, but no filed tax return for that year. That's it. There's no human being making a judgment call here, at least not at this stage. It is all run by machine. And how does the ASFR program even know who didn't file? Well, it just follows the data trail. Remember, the IRS gets a copy of every single W-2 and 1099 that gets issued. So if your client got any of these forms you see here, a W-2, a 1099-B from a stock sale, whatever, but no return was filed, that account gets flagged by the ASFR program, and the whole process officially begins. Okay, so the system has been triggered. Now let's talk about the legal side of things. What gives the IRS the right to do this? This isn't just some made-up collection tactic. This power comes straight from Congress, and it's grounded in a very specific part of the Internal Revenue Code. So the legal authority for the SFR comes directly from Internal Revenue Code Section 6020B. That's the key. This code section says, point blank, that the Secretary of the Treasury can prepare a return for anyone who fails to make one themselves. And here's the kicker. For most purposes, once the IRS prepares and signs that return, it's treated as if the taxpayer filed it themselves. Now, this is what I find so interesting. What does it actually take to make one of these SFRs legally valid? According to the Treasury regulations, it's just 3 simple things. It has to identify the taxpayer, have enough data to calculate a tax, and say that it is a Section 6020B return. That's it. Notice what's missing. The taxpayer's signature, any consent from them, any kind of verification, none of that is required. And this just lays out the final steps perfectly. The whole process is basically a 3-step dance. The system identifies the taxpayer and spits out a liability. Then some authorized IRS employees signs a certification form, like a Form 13496. And with that one signature, bam, a bunch of computer printouts just got turned into a legally binding tax return, whether your client agrees with it or not. Okay. Let's move on to probably the most damaging part of the entire SFR process, the calculation itself. The system is engineered with what I call a mathematical asymmetry, and it's deliberately designed to work entirely in the government's favor. Think about it. When you prepare a return, your goal is to figure out the correct minimum tax owed by applying the law. The ASFR system does the exact opposite. As you can see here, it defaults to the worst possible filing status, usually single or married filing separately. It allows only the standard deduction, and it pretends every single potential credit doesn't exist. The final number often has very little to do with reality. I mean, just look at this list. We're talking about the Earned Income Tax Credit, the Child Tax Credit, education credits, things that can make a massive difference for working families. The ASFR system ignores them all. Even worse, it assumes that 1099 NEC income has zero business expenses, and that any stock sales on a 1099-B had a cost basis of zero. The liability it creates can be absolutely catastrophic. So once the IRS has calculated this massive, maximized liability, what's next? They can't just start collecting on it right away. First, they have to send a formal legal notice. And this notice is, without a doubt, the most important piece of mail a taxpayer in this situation is ever going to receive. This notice is the Statutory Notice of Deficiency, or SNOD, but we all know it as the 90-day letter. This letter is your client's one and only ticket to the U.S. tax court. It gives them the right to petition the court and argue about the proposed deficiency before the tax is assessed and the collection machine starts up. It's their one shot at a prepayment judicial review. And that clock starts ticking the second the letter is mailed. The taxpayer has exactly 90 days, or 150 if they're out of the country, from the date on that letter, not the day they get it, to file a petition with the tax court. If they miss that deadline, even by one day, that door to tax court slams shut, for good. The chance to fight it before paying is gone, forever. Missing the 90-day deadline is a huge, huge mistake, but it's not the only one. The way the SFR process interacts with all the different statutes of limitation can create some incredibly nasty traps, especially when you're trying to get a refund for your client. The main idea here is the Refund Statute Expiration Date, or RSED. This is the deadline for claiming a refund. Now, we all know the general rule is 3 years from when the return was filed, but a much tougher, more restrictive rule kicks in when you file a return late, which is, always the case when you're fixing an SFR. And this leads us to the infamous Look-Back Trap under IRC Section 6511. The logic here is so important to understand. Let's just walk through this example. Your client's 2019 withholdings were legally deemed paid on April 15, 2020. The law says a refund claim, which is the late return you're filing, can only get back taxes that were paid in the 3 years right before the claim was filed. So when your client files in July 2023, the look-back window only goes back to July 2020. But their withholdings were paid before that, in April 2020. They fall outside the window. The refund is permanently blocked. They literally forfeit their own money to the Treasury. Okay, so after making it through this procedural and statutory minefield, what's the way out? If your client is looking at a huge assessment from an SFR, how do you fix it? The good news is, while the problem is complicated, the main solution is actually pretty direct. The single best thing you can do is prepare and file a complete, accurate, original Form 1040. IRS policy says that a valid, signed return from the taxpayer will replace the SFR. This is the move. This is what lets you fix the filing status, claim every single legitimate deduction and credit, and recalculate the tax liability to what it should have been in the first place. Now, what if the tax from that SFR has already been formally assessed on the books? There's another tool you can use called Audit Reconsideration. This is basically an administrative process where you can give the IRS new information, like that properly prepared tax return, and ask them to reevaluate the assessment without having to go to court. It's a super useful tool, especially when the SFR assessment is as wildly inaccurate as we've been talking about. And that really brings us to the end of the process. The substitute for return is this powerful, automated machine that's built for efficiency, not fairness. And it has some really serious consequences. So the final question I'll leave you with is this. Knowing the mechanical, punitive nature of this system, how does that change your strategy for keeping your clients compliant in the first place and for helping those who have already fallen behind? The answer to that question could literally be the difference between a happy client and one who's facing financial ruin.